Welcome to the podcast that unveils the future of investing. In each episode, we explore asset classes, trends, and technologies with founders, investors, and experts involved into shaping that future. Today, your host George Ali Ferris is talking to Alokik Advani, managing partner at Fidelity Strategic Ventures.
Having been a fintech investor for almost 2 decades, there's no one better to talk to about the future of investing. Alokik, welcome to the show.
Thanks very much for having me, George.
We discussed about so many interesting things last time. I'm glad we had an opportunity to continue this conversation, even if it's 2 years apart. Can you just remind our audience what is your role and what's the purpose of Fidelity Strategic Ventures?
Sure. So when we set up this business, our goal was to do two things, right? One is to connect the dots between the inside of Fidelity and the external world from an innovation perspective, connect our wealth management and asset management colleagues with some of the innovations taking place in the startup world, et cetera. So that connectivity is really important. And that connectivity helps to spur innovation. The second part of that is then the investing, which is once we join those dots, we create some thematic views, some thesis on the back of which we want to go and make investments. Those investments usually serve two purposes. One is they have some strategic impact to Fidelity now or in the future. And two, they're able to provide some financial returns, which are also very important.
Great. So there's this strategy and also thinking a bit more like a traditional VC in terms of returns. But in terms of your approach, how is it different from, let's say, traditional venture capital? One of the things that I observe is that from a VC perspective, you have a very concentrated portfolio, about 12 or 13 companies. And typically, if we look at VCs, they would have a specialty in terms of fund size, in terms of rounds, entry level. How do you approach that?
Absolutely. So I think if we look at it from a sectoral focus, size focus, and then stage focus, we'll be able to break that down a little bit. So we always say that we're specialists, even within fintech, we specialize a lot, given that Fidelity, for whom we're trying to be a strategic investor, is a wealth manager and an asset manager at its core. We tend to look at things that touch that space. So not only businesses in wealth and asset management, but anything that touches that world. So it could be digital wealth, it could be capital markets, it could be reg tech, alternative assets, AI and analytics, blockchain and operational efficiencies, and anything else that touches that world. But we also say very clearly what we're not doing in the fintech world, which is payments, lending, and insurance, because we don't play in those businesses. So that's from a sector focus. So as a result of that, we can go very deep in those domains and look at pretty much all the companies that might exist and develop views on which ones we like and which ones we don't, based on the businesses that they're doing and the quality and reputations of the founders. I think the second part is, as you said, on round, stage, and size, right? So we have a flexibility of doing this, given the fact that we're not structured as a fund. We don't have to go out and raise money from third-party LPs. We get all our money from the Fidelity balance sheet, on the back of which we make investments. We can be a bit more flexible. Oftentimes, we like to say that the companies that we invest in have, proven product market fit. They've got some clients and they've got some revenue. So we're not starting purely seed stage. So ideally what that positions for is Series A onwards, but we've made investments pretty much through the alphabet from Series A onwards through D and E as well. We've made investments as small as $1 million and as large as $30 million over the last 3 years.
Another question is perhaps about the strategic fit versus the valuation. Typically, my understanding is that when it gets a strategic investor, it's they expect a higher rate, but you participate along with others. So how can you both be a participant and a strategic investor?
We evaluate each of those on their own merits. I think that strategic premium is more an expectation in an M&A situation when someone's coming to buy out a business. As an investor, we expect to play at the same pricing, valuation, and sensitivities as most. I think given the last 12 to 24 months, I've seen valuation exuberance. We've had to choose and pick our spots as to where we have belief and conviction and where we don't. And again, we can be much more selective based on where we wish to invest and where we don't. We're not doing it as a result of catch up or FOMO. We're doing it more because we believe there's some strategic angles for us now or in the future. So I think that part is important, right? We don't like to miss investments. We like to be in most of the conversations. We're very happy to co-invest. We're very happy to lead. We're very happy to follow. So it depends on the situations. We can play in any of those roles.
We talked about strategy, and I guess sometimes the bottom line could be M&A down the line, or at least a possibility. But there's also ongoing collaboration. I've listened to another podcast, one of my favorite one, Alt Goes Mainstream, where we talk about how you commercial partnership and active collaboration with Moonfair, one of your
Yes.
portfolio companies. So is that
Yes.
typically the case?
We have about 15 portfolio companies right now, and almost half or more of them have some strategic collaboration or relationship with Fidelity. Now, it doesn't always mean that strategic partnership or collaboration happens before we make the investment. Sometimes it can happen before, sometimes it can happen after, sometimes it happens at the same time. Again, there we can be flexible in understanding that.
Yeah, it's a very interesting approach. There's a lot of talk about corporate venture capital and how it's a very difficult exercise. You really a reference in that space. So now, if we look at the individual companies and how they form a portfolio, because there's 15, perhaps there's too much to go through all of them, but could you give us an overview, maybe per category or a quick
Sure.
selection so that we understand the
Sure. I was
diversity?
thinking about this a little bit before I joined this podcast with you. And I think that, if we look at some of our businesses, they largely break down, I'd say, into 3 to 4 categories in the way that we've done it. Now, we express our theses a little bit more finely, but the portfolio breaks down 3 or 4 categories. We'd say largely retail focused investing and savings. And when I'm saying retail, it doesn't mean always the mass market, but mass through mass affluent. And within that, there's several companies that are focused directly on a B2C basis, or some are intermediated. So examples of that on a direct investing basis is a platform in the UK like Moneybox, which has grown and scaled significantly across its investing and savings propositions. We have similar businesses in Southeast Asia and India with Stashaway and Covera. And the most recent one we've done in that space is a business called Stacked Invest, which is in the US, which is basically a crypto robo advisory platform. But then when you look at the intermediated space, similarly around this investing saving journey, there's a few that come up, right? So one is a large company now that's had a monster round recently called Drive Wealth, which is providing, you know, end investors through whichever fintech they're accessing access to the US retail trading market for stocks and soon to be crypto. The other one is a platform for the IFA community called Conquest. So that entire thesis around investing and savings and the advice and the planning that goes on top of it, all of that sort of sits within that genre. And we think that there's a lot to do there. As you and I have spoken about before, I still believe that advice journey is somewhat broken and there's a lot to be done there. And it's still, till date, nobody's been able to fix that perfectly. The second one that I'd categorize is this kind of startup private company journey from seed, from inception through till IPO. Oftentimes you have platforms that sort of offer seed investing and angel investing for many people, but we haven't done anything there. But the 3 companies that we've invested in this journey is one is CapDesk, that's helping companies with their cap table management and employee stock option plan management. It's a Danish company that's focused on UK and continental Europe for now. The second one we invested in is a sort of access to private equity and venture capital, Moonfair, which again has got a lot of publicity and recently raised a significant round. And the third one, which is retail access to IPO at the time that they go public, which is Primary Bid, again rumored to be raising a significant round. So that's that second journey of that private asset, private company journey. What else happens within that entire journey and ecosystem? The third one I would say is more B2B fintech companies that serve the enterprise needs of financial services and beyond, right? Within that, we've got players like Finborn, which is renovating the asset management tech stack. We have Steeli that's providing compliance and surveillance. We have Alpima that's providing model portfolios. And there's a couple more along that ecosystem, right? There's 2 companies that I haven't been able to disclose yet because we haven't announced them yet. But broadly, that's how I see that the sort of portfolio stacking up. And, the benefit that we have oftentimes is we come up against specialist players that focus on consumer segments or intermediate segments or B2B segments. We have the ability to play across all, but because we're playing in this niche space across wealth and asset management, we're able to go a bit deeper, I would think.
Being someone who is very interested in the future of investing, how many companies I've come across, so many in my podcast, Steeli, one is a client, Alpima. One I'm using, primary bid. So I'm glad that it's a verification for me that I'm following the thing, but also how Fidelity manages to be at the core of everything. If we go back to this advice journey, to me, it's something that has been a hot topic and talking about financial health and not just wealth and things like that. But there are a couple of trends that I find particularly interesting, and maybe you can comment on that. One, as you mentioned, is the mixing of savings and investing. There's no longer two separate things. And second, and I think they go together with drive wealth, the embedding of investing in potentially everything you do. So we have the possibility to no longer have to save money, deposit it something, and then take an active investment decision. I don't know how you feel about that.
Yeah, it's an interesting one, right? I think in the old days, you'd have to go either to one large bank or one large financial services place and do everything in one house. But it was often a closed architecture of what you could access, so there was limited choice and things. Then we had this notion of democratized finance, and we broke everything apart. Now what you're trying to do is not bring the parts together, but you're trying to interoperate the different parts. Because at the core of everything is the data which you want to get, like to provide the best form of advice, financial planning or advice across the top. You want to bring all the bits together. Now, that's your bank account, your insurance, your saving, your investing, your mortgage, pension, everything, together. Now, that doesn't mean you're going to bring them into one pot, but you want to be able to access the data appropriately, right? With the start of open banking across the UK and Europe, I think that's a great start. And then you extend this to some of the other pieces, you can bring more bits together. As the regulation is probably taking a little bit longer, people are trying to do this in other ways. So whether it's partnerships, the sharing of data with consent, or other forms to bring some of this together, because then someone can get an overlay on top that tells you what to do, which is, someone got a windfall gain, or they got an end of year compensation or a bonus or something, and they can say, okay, I have £5,000. Tell me what to do with it. Where should it go? I don't want to have to go and look at everything. And it just trickles through the tree and tells them where to put everything along the way. So I think that part is really interesting. I think the second part around it is with that data, you create a level of hyper-personalization to be able to tell you what you may want, what's interesting to you based on your behaviors, your tastes, your preferences. We're seeing a lot of this across the US, just given how the market structure is set up and a level of sort of custom indexing and personalization that very much is going to come across UK and Europe and beyond as well, where you should be able to construct something that represents your own tastes and preferences. Now, that's not saying here's a blank canvas, fill it with every little thing you want, but giving you some suggestions, some structure, some themes, exclude this, add that, that type of model towards an end state. So again, people have talked about this a lot, but it's the extension of that Netflix, Amazon model to financial services, right?
Yes, and obviously this is something that's quite available to high net worth individuals. And now getting someone more available, and we're not going to discuss about the type of retail investors. Obviously, there's some constraints here, but it's definitely the personalization is definitely a big change. And on top of that, and now I go one level up the stack, the choice of investment, again, to this broad retail, but probably more accredited or high net worth individual, is incredibly different. You mentioned primary bid and Moonfair, but there's also tons of startups that do whatever, from painting to sneakers to
Absolutely.
You name it. And how does that fit in the broader investment horizon and also Fidelity's perspective?
I think that's really interesting. So I think in the first instance, the view used to be, how do you balance your portfolio between equity and debt? That used to be an easy one. It depends on where the macroeconomic conditions are, the market activity, interest rates, etc. I think now when you look at that, and that was what the retail could do, if at all. But then when you look at a kind of 2021 beyond perspective, you'd want much more multi-asset view. You want to have stocks, you want to have bonds, might have mutual funds, you might have ETFs, you may have some quantitative type strategies that you can access. You may want to have a whole range of alternative assets, so traditional alternatives, right? So private equity, private debt, real estate, and infrastructure, but then a whole bunch of future state alternatives. You might want crypto and other digital assets and NFTs, but all of that can be within the same complex. And so in a world where the product cost across many of these things comes down, the package of how you can bring some of these together and someone's ability to give you some perspective around how those components come together and what's right for you becomes really meaningful. And so in a world, your traditional building blocks have existed for a long time. I think being able to couple the traditional with some of the alternative is really interesting. And I think that at the confluence of that is where the future state of asset management probably exists. And that's where Fidelity is also spending some time thinking.
This is something I've discussed with the president of the CAIA, the Charter Alternative Investment Association, and they reached the same conclusion. And in addition to that, I wanted to talk about a dimension in investing that's a lot more clear now. People tend to think like, the 60-40 portfolio is gone, but actually when you look at it, it's not a terrible thing to do. And at some point, I think a few years ago, I was one that was thinking robo-advisors and think that are automatically investing in ETFs are, again, they're not a bad idea, but clearly what we've seen recently, I'm thinking, GME, and I think that's something we see with crypto as well, is that investing is about more than returns, at least in practice. People want to belong, people want to, have fun, participate. And I think, to me, it's something that's obvious. And I wonder as well how you can tackle that or how you can take that into account, this non-rational aspect of investing.
I think it's really interesting. I think that notion of, if you take a few examples, let's take two extremes. So one, you take the whole Robin Hood effect coming out of the US and the rise of retail trading and the meme stocks and Reddit so communities and others that were powering retail investing over the last 12, 18 months. And then the second part of it is the entire notion of much more awareness around sustainability, ESG, and an engagement towards it, right? We're living in a time and with a generation that is much more activist on some of those fronts and wants it to manifest their views. It's no longer good enough to sit on the armchair. They want to be able to be active. So both of those are coming back to some of your more social behavioral aspects around what adds to investing rather than just a statement at the end of the month saying you're up or you're down. So that is important. And so there's probably two or three different things that are interesting. One is that for a long time, there's been this distinction between the institutional crowd and the retail crowd. What you're seeing now with the level of democratization across several different asset classes is that's becoming equalized. Now, yes, you might pay a little bit more or you might have limited choice, but that's getting one. The second one is the people's ability to want to engage and, as you said, be part of a social community or trade or otherwise is much more prevalent. Like this was never, single stock trading and retail trading was never something that was hugely prevalent across UK or Europe. It was much more in the States and not in Europe. That's changed a lot over the last 12 or 18 months. Obviously, it's been the market movement and the volatility has provided that direction, and excess capital and time of being in lockdowns has also provided that. But I think this third part around engagement is really interesting, right? People want to voice and make sure that their money and where it's being saved, where it's being invested, resonates with their personal choices, their tastes and preferences, what their beliefs are, how they want to engage, what they want to do with the environment, how they want to create more carbon neutrality, how they want to create, more gender diversity. All of these things are really important to people. And I think that's where you bring the different facets together in learning, not just about your time duration to retirement and your return expectations, but the other things about you and how you can create engagement. And that's across both private markets and public markets.
Yeah, it's really an interesting space to watch. And I'd like to add a question about something that's perhaps not missing, obviously, but that we don't see so much in your portfolio, is the DeFi space, which is very important, I think, for asset management. And on top of that, we really cannot criticize Fidelity for not being present in the space, because Fidelity Digital Assets, I think, is leading the way. Can you comment on that? DriveWealth is going into crypto, and I'm sure there's activities there, but it's a small proportion.
We have several portfolio companies that are adding on crypto and access to it in different ways. Fidelity Digital Assets has definitely been at the forefront of providing a much more institutional grade access to crypto custody and execution services around that, led by a former colleague and close friend of mine, Tom Jessup. But I think the interesting parts we'll touch on DeFi, but then also what Fidelity may be doing. So I think Fidelity in Canada recently launched an exchange-traded access product in custody. We're looking at other places around the world where we're able to offer exchange-traded products as well, and hopefully, are able to make progress on that front in the near future. From a DeFi perspective, we're looking at that space quite actively. So I think that the first investment we made in pure crypto related is this crypto robo-advisor platform called Stacked Invest that lets you aggregate your crypto across different wallets and then be able to provide active, passive, or bot portfolios alongside. Or if you don't have any crypto, you can get access to it through that, but in a little bit more wrapped manner. I think that's the first foray we've done as a small investment in that space, but we're looking actively at the DeFi space. And I think for us, a lot of the importance comes in the bridge from crypto to traditional finance. How are those pieces coming together so that you're not living in two parallel worlds? Someone who's living in your traditional finance world can still access crypto yield or staking, lending, other things along those ways. So how are you able to take almost an embedded crypto capability or a bridge from crypto to traditional? So I think that's really interesting. I think the other part is, there's plenty of hype recently around the NFT craze and the potential that it has across the future state of the metaverse. From a traditional finance perspective, I think we're still a little bit of a ways away. But again, if that does take off and get steam and scale, there's the potential to offer a range of financial services around that.
Yeah. Two remarks based on what you said. First, we discussed with another podcast guest who I think you know, Hirender Misra, who is all about bridging, let's call it DeFi and CeFi. This is, I think, such an important topic. And on a personal level, I've just spent the last few hours trying to figure out how to get onto different platforms who have different limitations, etc. So I can see very personally how a robo-advisor or some kind of a service would be very helpful. So I'm looking forward to getting to knowing more about this. That's been a really good roundup in terms of what you're doing as a company, different very big trends in the investment space and potential investment there. So I think it's time to conclude unless you have something else to add. And my question would be, how do you invest personally?
That's interesting. So I think I'd say a few extremes. So on one side, it's the more traditional investing, given the constraints that we have on levels of disclosure or approvals and things around certain financial assets. Take a little bit more of a traditional and a long-term approach where you don't get so spooked by the volatility in the market. Try and aim to have as multi-asset exposures as you can. And then a lot of what I really enjoy is also angel investing and investing on the private side into early stage companies where it has nothing to do with fintech, so there's no conflict or any issues there. It's usually businesses that I can understand, technologies I can understand, or founders that I've been introduced to. And so those are the two extremes of investment in my world, the more traditional, long-term focus and based, or more angel investing that's extremely speculative.
And from our last conversation, I remember I asked, what would you do if you weren't doing this? You'd say the food is my other passion. Have you ever thought of combining the two and investing, I don't know, in real assets?
I have done a few of those through people I've come across. Not always they're very fun, not always the most lucrative. Very tough businesses many times over. But yeah, no, it is very much a passion of mine as well. More the eating than the investing into food.
Yes, okay. That's just to close the loop on what we discussed about investing is not just about a return. So I see you're practicing as well what you're seeing in the market. Wonderful, Alokik. That was great, as always, to talk to you. I'm sure there will be an opportunity to have a third conversation, but this was fantastic. A lot to take in, and we wish you all the best and really looking forward to what's new at Fidelity, the strategic ventures, and what your team is doing. Thank you.
George, thanks for having me again. It's always a pleasure to speak with you, and all the best.
Thank you very much for listening. Please subscribe for more conversation with individuals who are shaping the future of investing.